Like getting money for nothing? How about getting more money for nothing? Want to learn about companies that keep rewarding their shareholders with ever bigger dividends? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. Look, I like being productive as much as anyone else. A life of pure leisure is boring and unfulfilling in my opinion. But getting paid for doing nothing at all, it's hard to complain about that. Getting paid ever more money for doing nothing? Now we're really talking. Well, that's the life of a dividend growth investor. When you own shares in world-class businesses paying safe, growing dividends to their shareholders, you're getting paid ever more money for doing nothing other than not selling those shares. That's so easy, even I can do it. When you collect enough safe, growing dividend income to cover your bills, you are financially free. And financial freedom is worth more than any luxury product or service that you could possibly think of. Today, I want to tell you about 6 dividend growth stocks that just increased their dividends. Ready? Let's dig in. The first dividend increase we have to talk about is the one that was announced by General Dynamics Corporation, stock ticker GD. General Dynamics just increased its dividend by 4.8%. A bit smaller than I was expecting from General Dynamics, which used to be known as Generous Dynamics back in the day, but let's keep things in perspective. This was still a quote-unquote pay raise for doing nothing other than holding shares in a great business. This marks the 32nd consecutive year of dividend increases for the Aerospace and Defense Corporation. Yep, this is a dividend aristocrat, been one since 2017, and I think it'll remain one for a long time to come. The 10-year dividend growth rate is 9.5%, which is obviously really solid, but recent dividend raises have been in this mid-single digit range. That largely comes down to the fact that the aerospace side of the business, i.e. Gulfstream, was severely impacted by the pandemic. But defense is strong, contracts keep rolling in, the backlog is over $90 billion, and aerospace is rebounding. Meantime, the stock offers a 2.3% yield that's protected by a healthy 43.3% payout ratio. This stock is down nearly 10% year to date, and the valuation looks pretty reasonable here. I see no expensiveness here. The price earnings ratio of 18.7 is certainly not egregious, although it does trail its own 5-year average of 16.8. Then again, the stock spent a good period of time in the penalty box as a result of the aforementioned troubles around aerospace, and that drags down the average valuation. We can see a sales multiple of 1.6, which is just slightly ahead of its own 5-year average of 1.5. Overall, this dividend aristocrat strikes me as a good long-term investment candidate for dividend growth investors. You've got a huge backlog and a rebound in aerospace, and it's not terribly expensive. The second dividend increase we have to cover is the one that came in from Linde PLC, stock ticker LIN. Linde just increased its dividend by 9%. This company is just so consistent. It's a beautiful thing. If you're a long-term dividend growth investor, Linde is exactly the kind of business you want working for you so you don't have to. The global industrial gases company has increased its dividend for 30 consecutive years. Yet another dividend aristocrat doing what dividend aristocrats do best: relentlessly increase the dividend. The 10-year dividend growth rate is 7.8%. Nice to see a dividend raise that's even higher than that already acceptable level. The one thing you do have to sacrifice here though is yield. The 1.4% yield might leave something to be desired, but this isn't some high yield junk stock. It's a high quality compounder that continues to make investors wealthy. With the payout ratio sitting at 38.2% based on midpoint guidance for fiscal year 2023 adjusted earnings per share, I foresee many more years of compounding that dividend. This stock isn't cheap, but why should it be? I've said it before, I'll say it again. You tend to get what you pay for. We recently analyzed and valued this business, estimating fair value at slightly over $351 per share. That video highlighted Linde when its shares were trading hands for about $329 each. So I saw a favorable gap between price and value. But a lot of the comments in that video kept going on about how expensive the stock was. Yet, here we are, and the stock is run even higher, now sitting at $355. What else has happened since that video went out? A solid Q4 report with impressive fiscal year 2023 guidance, and this 9% dividend raise, of course, which makes the stock that much more appealing than it was when the video came out. This stock is up 150% over the last 5 years alone. If you've been sleeping on Linde, now might be a good time to consider waking up. The third dividend growth stock we have to have a quick discussion about is the one that came courtesy of Realty Income Corp, stock ticker O. Realty Income just increased its dividend by 0.2%. 0.2%? What gives? Well, I'll tell you what gives. Realty Income tends to increase its dividend multiple times per year, and they add up, as I'm about to show you. This is the 30th consecutive year in which the Real Estate Investment Trust has increased its dividend. Here we go again, another dividend aristocrat. Notice a trend yet? Okay, so let's break this down. The 10-year dividend growth rate is 5.3%. Like I said, those small dividend raises, when they're coming in many times per year, can really add up. Indeed, the dividend is already up 2.6% on a year-over-year basis, year to date. We're about halfway there to the 10-year dividend growth rate, ahead of schedule. You know what else comes in many times per year? The dividend itself. That's because Realty Income pays its dividend monthly. So that's a monthly dividend being raised multiple times per year. If that isn't awesome, I don't know what is. Oh, and the stock yields 4.8%. Very decent income here. Based on midpoint guidance for fiscal year 2023 funds from operations per share, the payout ratio is 75.2%. That's right about what I'd expect for a REIT. This stock is priced quite a bit lower than it was before the pandemic hit. And that's despite the business and dividend advancing since then. This was an $80 stock in early 2020. It's currently a $63 stock. Interest rates are quite a bit higher now, I get it, but this stock was in the doldrums even before the rate hiking cycle took off. I'm really not sure why the market continues to punish this name. However, that could be just the opportunity long-term dividend growth investors are looking for. Based on that aforementioned guidance, the forward price to funds from operations ratio is only 15.6. That's somewhat analogous to a PE ratio on a normal stock. We can also see that the price to cash flow ratio of 15.1, that's close to what I just mentioned. This stock's 5-year average price to cash flow ratio is 19.6. We are way off of that. In my view, Realty Income is very attractive right now, especially for income-oriented dividend growth investors. The fourth dividend increase I have to bring up today is the one that came in from Oracle Corporation, stock ticker ORCL. Oracle just increased its dividend by 25%. Boom, old tech dropping the hammer. While a lot of flashy new tech businesses get headlines, in spite of not making any money, stodgy tech companies like Oracle continue to make a lot of money and reward their shareholders with generous dividend raises. This is the 15th consecutive year of dividend increases for the multinational database management company. With a 10-year dividend growth rate of 18.2%, you can see that huge dividend raises are nothing new for Oracle. However, oftentimes you'll see a deceleration in dividend growth from such a high starting rate. Not in this case, obviously, as this 25% dividend raise was actually an outsized one. Now, you do have to give up some yield in order to access that kind of dividend growth. The stock yield's only 1.7%, but Oracle has been an underrated compounder. And with a balanced payout ratio of 52.8%, the dividend is positioned to continue compounding away. This stock has gone on a huge run, and I'd personally like to see a pullback before considering buying the shares. The stock is up by more than 40% over just the last 6 months alone. As a result, it may have gotten ahead of itself. The price earnings ratio of 30.9 is looking rich to me, even by Oracle standards. The 5-year average PE ratio is 27.1. And it's not just an earnings thing. Every other multiple that I see is running ahead of its respective recent historical average. Great business, not so great valuation. I'd wait for a better price. The fifth dividend increase I have to bring to your attention is the one that was announced by Qualcomm Inc., stock ticker QCOM. Qualcomm just increased its dividend by 6.7%. That's right about where inflation is running at in the US on a year-over-year basis, and so what this means is Qualcomm shareholders are seeing their purchasing power remain intact. Sure, something closer to 10% would be better, but let's keep some perspective. It's a near 7% bump in pay for sitting on your hands, and the dividends are paid while you sit on your hands. Tough to complain about any of that. The global technology company has now increased its dividend for 21 consecutive years. Qualcomm has been such a reliable dividend raiser. I remember back when I first started investing in 2010, many investors thought that tech was a risky place for capital allocation, but that's been proven to be the wrong way to look at it. With a 10-year dividend growth rate of 11.7%, this most recent dividend increase was a bit smaller than one might expect. Still, you're pairing that high single-digit dividend raise with the stock's yield of 2.4%. Not a bad combination at all. And the payout ratio is only 30.9% even after this dividend raise, which gives the company plenty of room for more large dividend increases in the years ahead. In my view, Qualcomm is very attractive for long-term dividend growth investors. You don't often see quality and cheapness paired together, but that's what you've got here with Qualcomm. The company has nearly doubled its revenue over the last decade. Earnings per share has nearly tripled over that period. The healthy dividend continues to move up like clockwork, and yet the business is slapped with an earnings multiple of 12. I think that's vastly underestimating and undervaluing this business. For perspective, its 5-year average price earnings ratio is 24.4, so it's half of where it usually is. This premier tech company is not commanding the valuation it should or usually does. This one is worth a very close look. The 6th dividend increase I want to highlight is the one that came in from Williams-Sonoma Inc., stock ticker WSM. Williams-Sonoma just increased its dividend by 15%. Bam! Williams-Sonoma coming through yet again. This is one of the best niche retailers in all of America. All it does is sell more products, make more money, buy back shares, and increase its dividend. Love it. This is the 18th consecutive year in which the home furnishings retailer has increased its dividend. The 10-year dividend growth rate is 13.2%, so we can see that consistent double-digit dividend growth at play here once again. And the stock also offers a pretty compelling yield of 3%. Boy, if every stock I ever bought gave me a 3% yield and a double-digit dividend growth rate, I'd be totally delighted. If that's not good enough already, you also get a super low payout ratio of 22.1%. It's practically nirvana here for long-term dividend growth investors. But wait, there's more. How about an attractive valuation? We analyzed and valued this terrific business back in early October, estimating fair value for Williams-Sonoma at almost $178 per share. The stock is currently priced at about $121. Could the analysis and valuation be off a bit? Absolutely. Is it likely that it's completely wrong from start to finish? The odds of that are low. That said, there's a huge margin of safety here between price and estimated fair value. Williams-Sonoma announced a $1 billion buyback program along with that 15% dividend increase. That's 12.5% of the company. The company is buying back its own stock hand over fist while the price earnings ratio is below 8. I'd be inclined to join management on this one. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about these dividend increases. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. See you next time.